The decision to use a traditional IRA or traditional 401k versus a Roth IRA or Roth 401k can quite literally be the difference of tens or hundreds of thousands of dollars over time saved in taxes. The challenge is, most people have no idea where to start when it comes to deciding which is best for them. So in today's video, we're going to walk through the different points you should consider when it comes to deciding whether you should use a traditional or Roth savings account for your retirement. Hey everybody, I'm James Knoll, founder of Roth Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. Before we jump in and decide which is best for you between a traditional IRA or a traditional 401k and a Roth IRA or Roth 401k, let's quickly consider the cases for both because both have some tremendous benefits. Let's start with Roth IRAs. Number one, the biggest benefit of a Roth IRA is money in that account will never be taxed again. As you invest that money and it grows completely tax-free, it doesn't matter if your income is higher in the future, it doesn't matter if tax brackets are higher in the future, that is money that won't be taxed again. So the nice thing is it eliminates some of the uncertainty around taxes and how much of that money will actually be yours when you start to pull it out in retirement. Number two, Roth IRAs and Roth 401ks are not subject to required minimum distributions. Meaning when you turn 72, any money in a traditional IRA or traditional 401k, you're going to be forced to start taking that money out at some percentage each year, and that's an ever-increasing percentage the older you get. Well, with Roth IRAs, there's no required distributions. So that money can keep growing, keep compounding, keep expanding your tax-free income base, and you're not forced to take any out. Number three, Roth IRA income isn't included in provisional income. Provisional income is a calculation done to determine how much of your Social Security benefit is subject to taxes. Now, distributions from Roth IRAs is not included in that formula, meaning the more you have in Roth IRAs, potentially the less you might be paying in taxes on your Social Security benefit. And then lastly, and there's many benefits, but another big one is Roth IRA distributions are not included in Medicare IRMAA surcharges. So the amount that you pay in surcharges on your Medicare premiums is going to be based upon your adjusted gross income. So because Roth IRAs are tax-free, it doesn't factor that into that calculation of adjusted gross income, which means you have a higher chance of less of your Medicare premium having to be subject to a surcharge. Now, the case for traditional IRAs and traditional 401ks, it's pretty straightforward. You are able to defer taxes whenever you make those contributions. Now, this can be very beneficial when you're in high income tax bracket and expect to maybe drop to a lower income tax bracket in the future. For example, I recently had a client that I was speaking to, and this client came to me and he was maxing out or coming close to maxing out two Roth 401ks, one for himself, one for his wife. And at first glance, it was amazing. I love that. That's a lot of money that's going into a Roth account, which means we never ever have to worry about taxes on that money again. It can grow and compound and everyone lives happily ever after. But when we actually look at that, I saw a flaw in this. We ran the analysis and what we saw was currently my client was in about a 32% tax bracket. He was making pretty healthy income, his wife was making pretty healthy income, and so today they're in a 32% tax bracket at the federal level, and then California taxes are another 10 to 11% on that. Now compare that to retirement. We ran an analysis to look at where is income coming from, what are your income sources, what are your expenses, and what we saw was in retirement, he would be closer to the 12% tax bracket. So today, just looking at federal level, he's at a 32% tax bracket. In retirement, it would be closer to the 12%. So for this client, as much as I love Roth accounts, I said, hey, let's switch that. And let me show you why. Let's assume that instead of redirecting $40,000 into Roth 401ks, which between he and his wife, that's about what they were contributing, what if we did that to a traditional 401k instead? Well, at the 32% federal tax bracket, that would save him $12,800 in taxes. This is before even considering California taxes. So $40,000 to traditional 401ks instead of Roth 401ks. When you multiply that by 32%, which is their tax bracket, that was a $12,800 savings for those contributions. Now let's assume he retires in a couple years. Well, let's assume he pulls that same exact amount of money out of his 401k or IRAs. Well, he would be pulling it out at a 12% tax bracket, which would cost him $4,800 at that time to do. So 12% times 40,000. So could we do a little bit of tax arbitrage of saying, can we do traditional accounts? Can we do 40,000 traditional 401k, which saves you 12,800 in taxes? Because even if you pull that out, or maybe you don't pull it out, but maybe you convert it in retirement, it's only costing you $4,800 to do so. So this was an $8,000 swing in taxes saved just for this year alone, before even factoring in state taxes, which would have increased this. So this is just an example to show the benefit of traditional 401ks. The benefits of traditional IRAs is, can you defer money when you're in your higher income years, when you're in your higher income tax bracket years, so that you can then pull it out later when you might not be in such a high tax bracket. So both have benefits. Roth accounts and pre-tax accounts, there's great benefits to both. But let's start to consider, when does either make sense for you? Well, the first thing you want to look at is, what's your tax bracket today, and what will your tax bracket be in the future? Now, today's pretty easy. We know what our salary is or our income is, or at least have some close approximation, and we know what tax brackets are today. So it's not too difficult to see what our tax bracket is today. The future might be a little bit harder. Number one, you have to run some projections to see where will income be coming from. And number two, we have to have a best guess as to where will tax brackets be. We know where they are today, we know maybe what they'll be for the next few years as different changes go into place, but we just can't predict 5 years, 10 years, 15 years down the road. But you do have to take an educated guess. So let's say you look at this, you look at today, you look at the future. If those numbers are the same, then whether you do a traditional account or a Roth account really doesn't matter. It's going to have the same benefit, and here's why. Let's assume that you're in a 20% tax bracket today, and you're in a 20% tax bracket in retirement. Well, let's just use a very basic example. If you have $1,000 of your salary, maybe your salary is $100,000, we want to say, okay, I want to put 1,000 of it somewhere. Just use a basic example. If you save that $1,000 to a pre-tax 401k or IRA, just some pre-tax account, let's assume that that's going to grow by 10 times by the time that you pull it out in retirement. So in this example, $1,000 is saved pre-tax. That $1,000 grows to $10,000 because that investment goes up in value 10 times by retirement. Well, in retirement, you pull that $10,000 out after 20% taxes, it's worth $8,000. So the $1,000, you get the tax deferral, it grows, you pull it out and pay taxes, and $8,000 is the after-tax amount that you have. So keep that number in mind, $8,000. Well, now let's look at the Roth side. If we have the same $1,000 and we want to save it to a Roth, well, before we're actually going to get access to that $1,000, 20% is going to come off the top for taxes. So we mentioned we're in a 20% tax bracket, so $1,000 comes in, 20% goes away for taxes, $800 is left. Well, if that $800, if we invest it in the same investment and it goes up in value 10 times, that $800 turns to $8,000. Well, when we pull that out, it doesn't matter where taxes are because it's completely tax-free. So the after-tax amount is also $8,000. So as you can see here, if tax brackets are literally the exact same, it doesn't matter whether you do Roth or traditional. Both are going to provide benefits because both have tax advantages that a regular brokerage account doesn't, but the difference between the two is going to be minimal, if anything at all. So it's a very simple equation, but you ask yourself, if you're in a higher tax bracket today than you expect to be in retirement, you probably want to use a traditional account. Putting money there is going to save you in taxes, more money in taxes than you'll pay when you pull that out in retirement. But if you're in a lower tax bracket today than you are in retirement, then it probably makes more sense to use a Roth type account because you gladly pay more taxes today in exchange for not having to pay those taxes in the future when you're in a higher tax bracket. Another thing to consider when you're making the decision between Roth versus pre-tax is, are you close to any marginal tax brackets? Well, what do I mean by that? For 2021, to use an example, if your taxable income, if you're married, filing jointly with your taxes, if your taxable income is above $81,050, then your federal tax bracket jumps from 12% to 22%. So it almost doubles. If your taxable income is above $329,850, once it crosses that threshold, your tax bracket goes from 24% to 32%. So an 8% increase in how much taxes you're paying. Now, compare that to when your taxable income is above $172,750, again, married, filing jointly, your tax bracket goes from 22% to 24%. So really not that much of a difference. So as you're looking at your situation, if you are considering pre-tax versus Roth, if you could use a Roth account, or if you could use a pre-tax account, I should say, to make one of those pretty sizable jumps, to say, okay, I'm in the 22% tax bracket today, but if I contribute enough, it's going to drop me down in the 12% bracket. Or maybe I'm in a 32% tax bracket today, and if I contribute enough to a pre-tax account, it's going to drop me into the 24% tax bracket. Now keep in mind, tax brackets are progressive, so it's not like all of your income is subject to these taxes, but those are kind of bigger inflection points or bigger jumps. And can we strategically use pre-tax accounts or Roth accounts to get under, to be able to shield our income from those higher jumps? If that's the case, then that's where you could use both Roth accounts and pre-tax accounts to do a little bit of that tax strategy to make sure you're not paying more in taxes when those higher jumps come into play. Let's look at an example of how you might apply this. Let's assume that you have a 401k available to you at work, and you can choose either a traditional 401k option or Roth 401k or some combination of the two. Let's also assume that your income totally fills up the 12% bracket and puts you 10% or spills over into the 22% bracket by $10,000. Well, what you could do here is you could say, okay, some of my income is subject to 12% taxes, some is subject to 22%, even lower amounts are subject to only 10%, but what we're looking at is how much is spilled over into the 22% tax bracket. Well, could you hypothetically, if you're 50 and older and have $26,000 that you could contribute, do you maybe put $10,000 of that into the traditional 401k? Because what that does is that lowers your taxes. So it wipes out any taxes that you're paying at the 22% rate, and it brings you down to fill up the 12% bracket. Well, the 12% bracket, maybe we don't mind paying 12% in taxes today, because that's pretty low relative to where it will be in the future when you're looking at your retirement. Maybe for the remaining contributions, so the remaining $16,000, we do Roth 401k. So just to summarize that, are you doing $16,000 to your Roth 401k and $10,000 to your pre-tax 401k? Because what that does is it almost clears out your 22% tax bracket. You're no longer paying any taxes there, but you're almost saying, I'm gladly pay 12% federal taxes because now that money is growing completely tax-free. And if the withdrawal rates when I'm paying taxes, or if the tax rates when I'm withdrawing these funds are greater than 12%, well then I've come out ahead by paying these taxes now as opposed to the future. So looking at the different marginal brackets is helpful too. It doesn't have to be an all pre-tax or all Roth decision. Sometimes, if you're close to these different inflection points where there's a more significant jump, it can make sense to do a little bit of both. Now here's another thing to consider, is right now so far we're just talking about the financial side. So if you look at the spreadsheets and the numbers and the analysis, what gives you more money at the end of the day? Well, as much as we like to believe that finance is all a money decision, all a rational decision, there's a big psychological aspect to it as well. And here's the thing, if you just look at it, money in a Roth IRA is more valuable than money in a traditional IRA. Sounds like a very basic statement, and it is a very basic statement. Money in a Roth account is better than money in a traditional account when it comes to the after-tax benefit of that. Here's why that matters. Psychologically, when we're deciding how much should we save for retirement or how much should we save to our 401k, we usually start with a percentage and then we decide Roth versus pre-tax. So let's say I'm trying to save my 401k and I've decided I'm going to contribute 10%. Well, where should I put it, Roth or traditional? Well, if I've already decided 10%, Roth is going to be better in terms of the dollars and that benefit what they'll grow to. Not saying financially it's going to make the most sense if you just look at the spreadsheet version of it, but psychologically, if you've already committed to the 10%, money in a Roth account is going to be more beneficial than money in a traditional account. The real question, if we wanted to look at this as logically as possible, wouldn't be would I do 10% to traditional 401k or 10% to Roth 401k? If I'm in a 30% tax bracket, for example, the real question would be, should I do 10% to a traditional 401k or 7% to a Roth 401k? You see, what that's doing is it's factoring in my tax bracket. It's factoring in what's going to be the net change to my cash flow, to my take-home pay between those two. And at a 30% tax bracket, a 10% contribution to a traditional 401k and a 7% contribution to a Roth 401k would both impact my cash flow the same. The dollar amount reduction in my take-home pay would be the same. So if that was the conversation, then you can make a good case for rationally going through the pros and cons of traditional versus Roth. But most people, they decide on a percentage first and then decide should that be a Roth or traditional. And like I said, money in a Roth is better than money in traditional. So if you're psychologically already committed to 10%, sometimes I just tell people do the Roth and you'll figure it out. You'll figure out how to make sure the net difference in your cash flow each month is workable in your budget. Another thing to look at is, let's say you're maxing out your traditional 401k. And you say, okay, well, where else can I save money to? Well, if instead of maxing out your traditional IRA, you maxed out your Roth 401k, it's the same dollar amount. So depending on your age, it's either $19,500 or $26,000, at least those are the numbers for 2021, and it's the same dollar amount. But again, money in a Roth is better than money in a traditional in terms of the benefit of that money. So if you were instead to shift and max out a Roth 401k instead, it's the same dollar amount that you're putting in, but it's almost like it's increasing how much you can put into a retirement account because that money is never taxable again. So looking at it from that standpoint, more of a psychological standpoint than a rational and spreadsheet standpoint, money in Roth sometimes, if the equation is close or the analysis is close, sometimes I skew more towards Roth than traditional, but of course it depends on the scenario. Now, finally, there's some non-financial questions that you need to ask. As you're looking at Roth versus traditional, understand what would the impact of that be on your cash flow. It's going to have an impact on your take-home pay. So when you're looking at this equation, how is that going to impact every other aspect of your financial life? How is this going to impact your ability to pay the bills or to do other non-retirement things or save for college or pay down your mortgage or do other things that your money is also trying to do for you outside of just looking at Roth versus 401k? Money in retirement, it shouldn't be so black and white always. So if you're doing more to Roth or more to traditional, if that's impacting your ability to travel or save for college or save for a home or any of those other things, this is just saying take a look at everything. Not just on a spreadsheet what makes most sense, but how is this impacting everything else? Now, another thing that you could potentially consider is a lot of people, before doing more to a traditional or more to a Roth, where the benefit is, do I want my tax benefit today or do I want my tax benefit in the future? Maybe consider an HSA, a health savings account if you have the option. Why? Well, a health savings account, you get the pre-tax deductions today and the tax-free withdrawals in the future if you're using those withdrawals for medical expenses. So sometimes you can get the best of both worlds, and people spend so much time focusing on a Roth versus traditional that they're ignoring an amazing benefit right in front of them, which is the health savings account or the HSA. Now, make sure that makes sense for you with your health insurance needs and the total cost of the plan. But this is saying don't just look at Roth versus traditional vacuum, look at it in the grand scheme of things to see how it impacts everything else. Thanks for watching. This is James Canal with Root Financial Partners. If you found value in this video, please share it with someone else who you think would value from it or benefit from it. And if you want more resources about how you can prepare for secure retirement, be sure to check out the Ready for Retirement podcast, where we release a weekly episode dedicated to helping you create your secure retirement. And be sure to like this video and subscribe if you haven't done so already. And finally, if you're interested in how we help clients prepare for their secure retirement, be sure to visit our website at rootfinancialpartners.com.